The introduction of the psychology of money, titled The Greatest Show on Earth, sets the stage for the book's central theme. Success with money is not about intelligence or education, it's about behavior. Morgan Housel shares two contrasting stories that highlight this idea. On one hand, there's a technology executive who flaunted his wealth recklessly, showing off stacks of cash and throwing gold coins into the ocean for fun. Despite his financial brilliance, his lack of emotional control eventually led him to lose everything. On the other hand, Housel introduces Ronald Read, a janitor and gas station attendant who lived a humble life, saved consistently, invested in blue-chip stocks, and quietly amassed an $8 million fortune. These two stories illustrate a simple but powerful truth. Financial outcomes are not always determined by how much you know but by how you behave. Even the most intelligent people can make catastrophic financial mistakes if they don't manage their emotions and impulses. Conversely, ordinary people with no formal financial education can build extraordinary wealth if they have discipline, patience, and a long-term mindset. Housel emphasizes that finance is not a science like physics, where formulas produce precise outcomes. Instead, it's a soft skill one that's shaped by human behavior, emotions, and personal experiences. He points out that financial education often focuses too much on technical knowledge and not enough on the psychology of money, which is what truly drives our decisions. The introduction sets the tone for the rest of the book by arguing that everyone's relationship with money is unique. Our decisions are shaped by where we grew up, what we've experienced, and how we perceive risk and reward. Housel's goal is to help readers better understand their own financial behaviors and to provide insights that make success with money achievable for anyone, regardless of background or expertise. This opening sets the foundation for the book's key lesson. Money decisions are not about spreadsheets. They're about emotions, habits, and behaviors. Understanding this is the first step to mastering the psychology of money. Welcome to The Psychology of Money by Morgan Housel. This book isn't just about personal finance, investing, or wealth management. It's about understanding human behavior, decision-making, and the emotional complexities that drive our relationship with money. Morgan Housel uses compelling stories and practical examples to show that success with money is less about intelligence and more about behavior. Let's dive deep into the key ideas, starting with the first 5 chapters. In the first chapter, titled No One's Crazy, Housel makes a powerful observation. All persons' financial decisions make sense to them, even if they look irrational to others. Our understanding of money is shaped by personal experiences, which vary dramatically across people, generations, and economic circumstances. Imagine growing up during the Great Depression, where poverty and loss were everywhere. Your view of risk, saving, and spending would be cautious, even pessimistic. Now compare that to someone who came of age in the economic boom of the 1990s. They would see investing in the stock market as an obvious path to wealth. This chapter reveals an essential truth. No one has the same perspective on money because no one has lived the same life. Housel tells us that spreadsheets and financial models cannot fully capture the emotions tied to money, the fear, the optimism, the insecurity that ultimately drive our decisions. A Harvard graduate and a janitor may live in the same financial world, but they interpret it through vastly different lenses. The second chapter, Luck and Risk, reminds us that financial success or failure is often guided by forces beyond our control. Luck and risk are siblings, and they operate invisibly in every outcome. Housel shares the story of Bill Gates, who attended Lakeside School in Seattle, one of the few schools in the world with a computer in 1968. That opportunity gave Gates a 1 in a million head start in computer programming. Without Lakeside, there might never have been a Microsoft. But Gates' friend Kent Evans, equally smart and ambitious, experienced the tragic side of risk when he died in a mountaineering accident in high school. The same forces, luck and risk, dictated two radically different outcomes. Housel challenges us to recognize that success is never fully earned, just as failure isn't always deserved. When we see someone who's wealthy, we often attribute it to their skill or hard work. When we see someone struggling, we assume they made bad decisions. The truth is more nuanced. Life is complex, and outcomes are rarely 100% within our control. This realization encourages humility when we succeed and understanding when others fail. In Never Enough, the third chapter, Housel explores the dangers of greed when people can't stop reaching for more. He shares the stories of Rajat Gupta and Bernie Madoff, two incredibly successful individuals who risked everything for money they didn't need. Gupta, who rose from humble beginnings in Kolkata to become CEO of McKinsey, already had $100 million. But that wasn't enough. His insider trading scandal ruined his career, reputation, and freedom. Bernie Madoff, too, was already a successful businessman before his Ponzi scheme destroyed thousands of lives, including his own. The lesson is simple but profound. Knowing when you have enough is critical for financial success and personal happiness. Modern society constantly moves the goalposts of success. As soon as we achieve one milestone, we set another, and the cycle of dissatisfaction continues. Housel warns that the inability to define enough can lead to unnecessary risks that cost us everything: our freedom, our relationships, and our peace of mind. He reminds us that life's most valuable things, reputation, freedom, and happiness, are never worth risking for a few extra dollars. The fourth chapter, Confounding Compounding, showcases one of the most underrated forces in finance: the power of time and compounding. Housel uses the example of Warren Buffett to illustrate this principle. Most people know Buffett as one of the richest men in the world, but few realize that $81.5 billion of his $84.5 billion net worth came after his 65th birthday. How did this happen? Buffett started investing as a child and continued for more than 75 years. Compounding doesn't rely on brilliance, it relies on patience. Housel argues that the human brain struggles to understand compounding because it defies intuition. The idea that tiny, consistent gains can snowball into unimaginable wealth over decades feels almost absurd. But that's the magic of compounding. It rewards long-term discipline, not short-term brilliance. Most people fail to benefit from compounding because they give up too soon, expecting instant results. Housel's message is clear: success doesn't require extraordinary returns. It requires extraordinary endurance. In Getting Wealthy versus Staying Wealthy, the fifth chapter, Housel differentiates between two crucial skills: building wealth and preserving it. He argues that getting wealthy often requires taking risks, being optimistic, and embracing bold action. But staying wealthy demands the opposite: humility, caution, and the willingness to embrace room for error. Housel shares a critical truth: survival is the most important part of financial success. Too many people achieve wealth only to lose it because they underestimate the importance of stability. He uses the example of investors who take increasingly bigger risks after early success, believing they're invincible. The result is often catastrophic. Building wealth is about optimism, but keeping wealth is about survival: knowing when to step back, when to protect what you've earned, and when to stop chasing unnecessary risks. This chapter teaches us that being financially successful requires balancing boldness and prudence, risk-taking and risk avoidance. These first 5 chapters reveal the essence of the psychology of money. Our relationship with money is deeply emotional, shaped by luck, risk, and personal experience. Success comes not from perfect decisions but from consistent, reasonable behaviors. By understanding ourselves, our biases, our goals, and our limitations, we can make better financial choices and avoid the traps of greed, impatience, and overconfidence. Stick around as we explore the remaining chapters and uncover even more timeless lessons about wealth, happiness, and the way we think about money. In the 6th chapter, Tails You Win, Housel introduces the idea that success in investing and in life often depends on a small number of extraordinary outcomes, also known as tail events. In any financial portfolio or business venture, most results may be average or even failures, but a few rare, high-impact successes drive the majority of gains. He points to companies like Amazon, where Jeff Bezos himself admits that most of Amazon's big bets fail, yet the few that succeed create outsized rewards. The same principle applies to the stock market, where a small percentage of companies account for most of the market's long-term growth. Housel argues that understanding the power of tail events is crucial because it changes how we view risk and failure. You can make plenty of mistakes if your successes outweigh them. This concept also encourages perseverance. You don't need everything to go right. You just need a few things to go extraordinarily well. The trick is staying in the game long enough for those tail events to materialize. It's a powerful reminder to embrace the randomness of life and focus on the big wins rather than obsessing over small losses. Chapter 7, Freedom, highlights what Housel calls the ultimate goal of money: independence. Wealth is often misunderstood as the ability to buy fancy cars, big houses, or designer clothes. But the true value of wealth, he argues, is the ability to control your time. The freedom to wake up and do what you want when you want is the most tangible benefit of financial success. Housel shares how having control over your time, whether that's leaving a stressful job, taking time off, or pursuing passions, brings an unmatched sense of happiness. The chapter is a reminder that wealth should not be measured by material possessions but by how much flexibility and independence it provides. This insight reframes financial goals for the reader. Instead of chasing higher incomes for the sake of status, Housel encourages us to prioritize freedom, because it's the one thing that consistently improves quality of life. In Man in the Car Paradox, the 8th chapter, Housel explores the psychology behind why people spend money on status symbols. He explains that many people buy expensive cars, clothes, or homes to gain admiration and respect from others. Yet, ironically, those who see someone driving a luxury car rarely think about the driver. They think about themselves and how they would look in that car. The driver's intended goal of impressing others falls flat because people's attention is always inward. Housel's lesson here is powerful. Spending money to appear rich rarely earns admiration. Instead, it often highlights insecurity. True respect and admiration come from character, kindness, and humility, not from displays of wealth. This chapter invites readers to rethink their relationship with status and to focus on internal satisfaction rather than external validation. It's a liberating insight that helps shift financial priorities toward building real wealth rather than trying to appear wealthy. The 9th chapter, Wealth is What You Don't See, builds on this theme by focusing on what wealth truly is: unspent money. Housel explains that many people confuse wealth with visible signs of luxury, like fancy houses or expensive clothes. In reality, wealth is the financial assets you don't see: savings, investments, and the money left unspent. He shares a simple but profound idea. Spending money to show off wealth often undermines the ability to build it. Every dollar saved and invested is a step toward financial security and freedom, while every dollar spent is gone forever. Housel uses this chapter to challenge our perceptions of wealth and encourage readers to prioritize saving. By living below your means and resisting the urge to display success, you can quietly build real, lasting wealth. This shift in mindset is powerful and practical, helping readers understand that financial security comes from what you keep, not what you spend. In Save Money, the 10th chapter, Housel emphasizes that saving is the single most powerful tool for building wealth. Saving doesn't require a high income, exceptional investment returns, or even detailed financial planning. It simply requires the discipline to live below your means. Housel explains that saving money gives you options, flexibility, and control. It allows you to take risks, seize opportunities, and navigate emergencies without stress. Saving, he argues, isn't just about achieving a specific goal, it's about building a buffer that gives you peace of mind. Housel reminds us that wealth building isn't about chasing extravagant returns. It's about consistency and discipline over time. He shares a practical insight. Saving money is the financial equivalent of freedom. It's the simplest, most effective way to take control of your life. Importantly, saving doesn't require precise financial forecasts or perfect budgeting. It's about having a mindset that values long-term security over short-term gratification. By the time you reach Chapter 10, Housel has laid a strong foundation for understanding the psychology of money. Through real-world examples and timeless principles, he teaches us that wealth is less about intelligence and more about behavior, patience, discipline, and understanding what truly matters. He challenges readers to shift their financial goals away from status and consumption toward freedom, flexibility, and long-term security. The first half of the book reveals a fundamental truth. Success with money is simple but not easy. It requires the humility to accept what you can't control, the patience to let compounding work, and the discipline to save and live below your means. In Chapter 11, Reasonable, rational. Housel argues that financial decisions don't need to be perfectly rational, they just need to be reasonable enough to work for you. A common misconception in finance is that people must act with mathematical precision and optimize every decision to maximize returns. Housel disagrees. Humans are not robots. They have emotions, goals, and fears that don't always align with cold, rational logic. For example, paying off a mortgage early may not be the rational choice if the interest rate is low, but for some, the emotional relief of being debt-free is priceless. Housel stresses that financial success comes not from perfection but from behavior that allows you to stick to a plan over the long term. If you prioritize comfort and peace of mind over strict optimization, you're more likely to make sustainable choices. The takeaway here is powerful. Focus on creating a financial plan that works for you, not one that impresses economists. In Chapter 12, Surprise, Housel explores how the biggest events in finance and life are often surprises that no one sees coming. History is filled with financial crises, stock market crashes, and economic booms that experts failed to predict. Housel's message is clear. We cannot predict the future with certainty, so we must prepare for surprises. He explains that financial planning based on specific forecasts is inherently flawed because the world is too complex and unpredictable. Instead of trying to predict what will happen, it's better to build resilience and adaptability into your financial plan. Have a margin of safety, diversify your investments, and expect the unexpected. This mindset shift helps you navigate uncertainty without panicking. Housel reminds readers that life is full of unknowns, and the best way to prepare for surprises is to focus on flexibility rather than precision. Chapter 13, Room for Error, builds on this idea by emphasizing the importance of having a margin of safety in your financial life. Housel explains that room for error is about preparing for what could go wrong, not just what you hope will go right. The best financial plans are not the ones that rely on perfect forecasts or optimistic assumptions. They're the ones that can absorb mistakes, failures, and unexpected events. Housel uses examples from investing, where the most successful investors like Warren Buffett always factor in room for error. Buffett famously avoids risky moves, preferring to protect himself from losses rather than chase unrealistic gains. Housel stresses that life is unpredictable, and having a financial buffer gives you the ability to withstand bad luck and unexpected setbacks. Whether it's saving more than you think you need, diversifying your investments, or keeping debt low, building a margin of safety is one of the most practical ways to achieve long-term financial success. In Chapter 14, You'll Change, Housel explores how our financial goals and priorities evolve over time. He explains that what you want today may not be what you want 10, 20, or 30 years from now. Life changes, our careers, families, interests, and even our definitions of success shift as we grow older. This simple truth has profound implications for financial planning. Housel advises readers to build flexibility into their plans to account for these changes. Locking yourself into rigid goals or long-term decisions can lead to regret when your priorities shift. For example, someone in their 20s might focus on maximizing investment returns, but later in life, their priority might shift to protecting wealth and reducing risk. Housel's message is clear. Don't assume your future self will want the same things as your current self. The best financial plans are adaptable, allowing you to adjust as life evolves. In Chapter 15, Nothing's Free, Housel introduces a concept he calls the price of success. Every financial strategy has a cost, and nothing in life, especially wealth, comes for free. For example, investing in the stock market comes with volatility and uncertainty. The cost of high returns is enduring periods of decline and market crashes. Housel explains that many people fail at investing because they try to avoid this cost. They panic during downturns, sell their investments, and abandon their plans when the price feels too steep. But the price of success is unavoidable. Just like going to the gym comes with the cost of sweat and soreness, building wealth comes with the cost of discomfort, uncertainty, and patience. Housel encourages readers to accept these costs as part of the deal, rather than seeing them as penalties. By reframing volatility, risk, and even short-term losses as the fee you pay for long-term success, you can develop the resilience needed to stick with your financial plan. This insight is a game changer. Enduring the price of success is what separates those who thrive from those who give up. These next 5 chapters continue to build on Housel's central theme. Success with money is not about perfection, it's about behavior. Financial decisions don't have to be rational. They just need to be reasonable and sustainable for you. The world is unpredictable, and the biggest events are often surprises. Building room for error and accepting the costs of success help you navigate uncertainty and stay on track. Housel's wisdom is simple yet profound. By embracing flexibility, patience, and resilience, anyone can achieve financial security and freedom. Stay tuned as we continue with the next chapters and uncover even more timeless lessons on the psychology of money. In Chapter 16, You and Me, Housel dives into one of the biggest reasons people struggle with money: comparing themselves to others. He explains that everyone has different financial goals, time horizons, and risk tolerances, yet people often make decisions based on what they see others doing. For example, an investor who needs long-term stability might feel pressured to take unnecessary risks after seeing others make quick fortunes. Or someone saving for retirement might compare themselves to a friend who's spending lavishly in the present. Housel points out that this comparison is dangerous because it leads us to adopt strategies that don't align with our personal needs. He reminds us that financial success is personal. It's about finding a strategy that works for you and ignoring the noise of what others are doing. The world of money is full of conflicting advice because everyone's goals are different. The key takeaway here is to focus on your own path, your own priorities, and your own version of success. In Chapter 17, The Seduction of Pessimism, Housel explores why negative financial news is often more believable and captivating than optimism. He explains that pessimism sounds smarter because it's easier to imagine how things could go wrong than to envision slow, steady progress over time. For example, a headline about a stock market crash is attention-grabbing, while the idea of long-term market growth is boring and hard to visualize. Housel argues that while pessimism may sound more convincing, optimism is what drives progress and creates wealth. The stock market, for example, has endured countless crashes, wars, and recessions, yet it has consistently grown over the long term. This chapter encourages readers to recognize the bias toward negativity and adopt a more balanced perspective. While it's important to prepare for risks, it's equally important to remain optimistic about the future. Progress happens slowly, and believing in it allows you to stay invested and avoid panic when short-term setbacks occur. In When You'll Believe Anything, the 18th chapter, Housel highlights how people are prone to believing financial myths and stories, especially during times of fear or uncertainty. When faced with stress or confusion, people crave simple explanations, even if those explanations are wrong. For example, during stock market crashes or economic downturns, conspiracy theories and rumors spread quickly because people are searching for someone or something to blame. Housel explains that stories are more powerful than facts when it comes to money because stories connect with our emotions. A great story can override logic, leading us to make decisions that might not be in our best interest. To avoid falling into this trap, Housel encourages readers to develop critical thinking skills and recognize when emotions are driving their financial decisions. The lesson here is clear. Financial success requires ignoring noise, avoiding emotional overreactions, and basing decisions on evidence rather than myths or narratives. Chapter 19, All Together Now, serves as a powerful summary of the book's key lessons. Housel brings together the ideas explored throughout the chapters, reinforcing the central theme that behavior matters more than knowledge when it comes to money. He reminds us that financial success doesn't require genius, luck, or perfect decision-making. It requires consistent, reasonable behavior over time. Some of the core principles include understanding the role of luck and risk, knowing when you have enough, embracing the power of compounding, building room for error, and focusing on freedom rather than status. Housel's message is simple yet profound. The small decisions we make every day, like saving consistently, avoiding unnecessary risks, and staying invested, are what ultimately determine financial success. By applying these timeless lessons, anyone can achieve financial security, independence, and peace of mind. Finally, in Chapter 20, Confessions, Housel reflects on his own relationship with money, sharing personal insights that illustrate the book's lessons. He admits that while he writes about money for a living, His approach to personal finance is simple. Save consistently, spend less than you earn, and invest in a way that aligns with your goals. Housel confesses that he doesn't aim to maximize his returns or follow complex strategies. Instead, he prioritizes financial independence, peace of mind, and freedom. This chapter brings a relatable and authentic conclusion to the book, showing that the principles Housel discusses are not just theoretical, they are practical and achievable for everyone. His confessions reinforce a central truth. You don't need to be a financial genius to succeed with money. You just need to make small, sustainable choices that allow you to stay in the game for the long haul. In the postscript, a brief history of why the U.S. consumer thinks the way they do, Housel provides historical context for how Americans' financial behaviors have evolved. He explains how events like the Great Depression, World War II, and the post-war economic boom shaped the attitudes of different generations. For example, those who grew up during the Depression developed a deep fear of financial risk, while those who experienced the booming post-war economy became more optimistic and willing to spend. Housel uses this history to show that financial behavior is not just personal, it's cultural. Understanding these historical trends helps explain why people think about money the way they do, and why certain behaviors like saving or spending vary across generations. By the end of The Psychology of Money, Housel has delivered a clear and powerful message. Financial success is not about being the smartest person in the room. It's about understanding your own behavior, managing your emotions, and making decisions that align with your values and goals. Through relatable stories, practical insights, and timeless principles, Housel teaches us that wealth is not a number, it's the ability to control your time, reduce stress, and live life on your terms. If you take away one thing from this book, let it be this: the small, consistent actions you take with money are far more important than big, flashy moves. Patience, humility, and discipline are the keys to long-term success. Thank you for watching this summary of The Psychology of Money. If you found this video helpful, don't forget to like, subscribe, and share it with others who might benefit from these lessons. Let us know in the comments which insight resonated most with you. And as always, remember, financial success starts with understanding yourself.